I'm pleased to introduce today Carrie Killinger and Linda Kellinger. Carrie, as you may know, was chairman, president, and CEO of Washington Mutual, which at the time was the sixth largest depository bank in the United States prior to the financial crisis of 2008. He holds a bachelor's degree with honors and an MBA from University of Iowa. He's been a number of important positions in the industry. He was vice chair and chair-elect of the Financial Services Roundtable. He was vice chair and chair-elect of the Federal Reserve Thrift Industry Council. He was vice chair of the Seattle Federal Home Loan Bank here in Seattle. He's won literally dozens of awards and honors for his leadership in both national and international banking. He's currently the CEO of Crescent Capital. Interestingly, he followed me as chairman of the Seattle Chamber some years ago, and he spent his entire term trying to unscrew the mess that I left for him. Linda Kellinger was vice chair of the Federal Home Loan Bank of Des Moines, Iowa. She was a consulting partner in an international accounting firm and was publisher and editor of Overseas Business Magazine. Interestingly, she was the director of administration for the Iowa Department of Human Services, which, among other things, was in charge of the prison system and all the mental health hospitals in Iowa. Probably good training for being married to a banker. She has a bachelor's degree from Iowa State University, an MBA from Drake University, and has completed graduate work at Kellogg Graduate School of Management. She's currently CEO of Olympic Consulting. In 2002, Carrie and Linda founded the Carrie and Linda Kellinger Foundation, which has a mission of public policy reform, social and racial justice, building community, and access to the arts. They recently collaborated on writing the book Too Big to Fail and How the Last Financial Crisis Informs Today. I read the book last week, and I find it a fascinating history of the banking industry and the economic history of this country. Please join me in welcoming Carrie and Linda Kellinger.
Well, Bob, thank you so much. And I'm going to try to get our technology to work here because we have a number of slides that would be great if we can do that. Well, first of all, again, it's a real pleasure to be here, and let us talk a little bit about the book that we just released about a week or two ago. And I'm going to jump right into. We have three major themes that we had in our book that we want to talk to you about today, and the first is that the 2008 financial crisis should not have taken place. And we tried to spell out in our book, and we'll talk about here some of the policy mistakes that went on during that period. Second, we're going to talk about Washington Mutual, a little bit about how we believe it was not treated equitably and inappropriately seized by the regulators, and give you some of the behind the scenes details of what went on through there. And third, very importantly, and hopefully timely, is we see some risks going on today for a potential new crisis coming that's being caused by some policies by the Federal Reserve and by the government, and want us to talk about those to get the dialogue so that perhaps we can come up with some ways to avoid another crisis. I'm going to start off talking about 2008 financial crisis. Linda's going to talk about Washington Mutual and why that was inappropriately seized, and then we'll both come back and talk about some of the risks we see going on today. First, let's talk about that 2008 financial crisis. What really happened is that we were in a cyclical, or housing had grown too fast. It was in a bubble in the early 2000s, and it was primarily fueled by the Federal Reserve keeping interest rates way too low for an extended period of time. And the net result of that is that it caused housing prices to go much more quickly than the rate of inflation. For example, from 2000 to 2006, the cumulative amount of inflation in the country was about 20%, and housing prices rose 83% over that period. And it was because the Federal Reserve kept interest rates below the rate of inflation. Whenever that happens, it makes mortgages really affordable. But guess what? Everybody goes out and starts buying them, and started bidding up the price of housing nationally by too big of a margin. The other major thing that went on during that period is that the regulators were asleep at the switch and ignored massive growth in what we call an unregulated subprime system. And that was basically subprime loans being created to try to help get more people into homes, and they just were not done well. And that whole aspect of that merged with Wall Street with a rapacious appetite to want to buy all the loans they could, to securitize them, distribute them all over the world. And they had credit default swaps with AIG and others, and that whole intricate system that the regulators didn't pay any attention to it because they weren't regulated. So then housing was in a bubble, and it was going to go through a normal cyclical downturn when the Federal Reserve blew it. They didn't understand just how much of an effect that would have on the overall economy. So when housing prices started to fall some, instead of helping mute that situation and just kind of get us through it and provide liquidity and allow everybody to get through it, they withheld liquidity. And before they knew it, the whole thing started to come down, started to trend down in a major way. And then when they made the terrible decision to let Lehman Brothers fail, everything cascaded down. I was there firsthand. I saw their eyes. They were like deer in the headlights. They didn't know what they were doing. They were inconsistent, and we went into a major meltdown, which unfortunately cost millions of people their homes and jobs, and the whole system almost came to its knees. I'm often asked the question, who's to blame for all that? And naturally everybody points a finger at somebody else. The regulators want to point it at somebody, the Congress wants to point it somewhere and all that. My take is that there is plenty of blame to go around for everyone. First of all, the Federal Reserve made some terrible mistakes that helped fuel the downturn in housing and lack of liquidity. The federal government insisted on too much subprime lending because they wanted to increase home ownership around the world, and it just got carried away too far. Wall Street had a rapacious appetite for all these subprime loans to put into securitizations because they wanted to make money on them, and they fueled it. The regulators were asleep at the switch and missed these developments going on in these non-regulated companies, and the investors, of course, wanted as high a yield, so they were buying all this stuff. Congress and the executive branch were right in there demanding more subprime lending to get home ownership up, and they put pressure on regulated banks with the CRA, or Community Reinvestment Act ratings, and that hurt. And as I mentioned, when things got difficult, the regulators had no sense of what was going on and kind of just missed it, didn't treat people similarly and fairly, and it was just a real mess. So my answer is always, there is plenty of blame to go around, including, again, regulated banks, non-regulated banks, the policymakers, and we wanted to get that information all on the table so that we don't repeat the mistakes, because all the other books we've seen on this topic just focused on somebody pointing a finger at somebody else. And trust me, in this one, everybody deserves to have a finger pointed at them. So I think what I'd like to do now is briefly move over to the next topic about Washington Mutual and its inappropriate seizure, and ask Linda to talk about that.
You want to do that one?
Oh yeah, we'll do one before jumping over there. I made a comment. There's a real misperception out there that most subprime lending was done by banks, and it wasn't. Here's the chart to show the unregulated shadow banks originated 85% of all the subprime loans during that period. And the red, which is the cumulative of all regulated banks like JP Morgan Chase and Washington Mutual, and Wells Fargo and Bank of America, and everyone else collectively only did about 15% of the total lending. And for most of the organizations, Washington Mutual included, it was always a small part of the total lending. So many people have kind of misperceived that the bad loans that were coming out of here were primarily by these by regulated banks, but it was really more by the shadow banks. Okay. Go ahead.
Oh, thank you, Kerry. And thank you to the Bellevue Rotary. We appreciate the opportunity to talk to you. Just a couple of things about the book. We just found out that we won the Axiom Bronze Medal for one of the best business books of the year. And we also were named as one of the top all-time top 10 books on capitalism. It helps explain the world. And #1 bestseller on Amazon. So we're really grateful that we have people reading the book, and want to let you know that all proceeds from the book go to charity. And I know all of you have heard in the last 10, 12 years a lot about Washington Mutual. I'm sure you've heard that the bank developed an aggressive high-risk lending program to increase their bonuses. They ramped up mortgage originations, especially subprime. They grew way too fast. The lending standards were lowered. Loans performed badly. They didn't have enough capital and liquidity. Deposits were drained, and that's why the bank failed. The bank could have been saved. Also, people think the bank could have been saved if the bank would have accepted JP Morgan Chase's $8 bid. Well, none of that's true. And we have an opportunity now to look at the facts. And one thing that we have learned in the last few years is that the truth matters, data matter, and the facts matter. So, for example, the $8 bid from Chase, there was no $8 bid from Chase. It was a non-binding indication of interest. And Washington Mutual had hired Goldman Sachs and Lehman to study these options and give them a recommendation. And Goldman Sachs and Lehman said, this is, a non-binding indication of interest. You're not going to get any money from them. And so they really advised that Washington Mutual accept the much better solid offer that TPG had for the bank. And later on, years later, when the bankruptcy examiner was interviewing the Chase executives, they admitted that JP Morgan Chase had no intention of giving a bid for the bank. What they wanted to do is they wanted to convince the FDIC to seize the bank. And the seizure option was really handy for Chase because they wouldn't have to mark the assets to market if the bank was seized. There's no shareholder approval required. It could be a quick transaction, and they could pick and choose assets from the bank and from the holding company. At the seizure, the holding company of the bank had $33 billion in assets and only $8 billion in liabilities. When the dust settled, Chase ended up getting over $11 billion out of the holding company's $33 billion in assets. Another myth that we have heard is that Washington Mutual grew way too fast and, explosively grew without many controls. But if you look at the facts, from the end of 1999 until the middle of 2007, Washington Mutual only grew 5.2% a year. That's not explosive growth. That's really an indication of very carefully planned growth. So the other things is that the asset quality was better than the industry, and Washington Mutual did not ramp up lending, but actually starting in 2003, reduced mortgage lending by 74%. Their lending standards were not decreased, lending standards were increased, and loan losses were less than the industry. The capital and the liquidity in Washington Mutual was stronger than the industry. And the deposit outflows after the Lehman bankruptcy had already stabilized when the bank was quickly seized. Tens of billions of dollars could have been drawn down from the holding company or even their line of credit sources like the Federal Home Loan Banks. So Washington Mutual was kind of caught in a Bermuda Triangle. On one side, you had Hank Paulson, Treasury Department, who put out a report in March of 2008 that he wanted to eliminate the thrift industry within 2 years and meld it into Wall Street. And then on the other side, you got FDIC, who was panic-stricken after the Indy Mac seizure and was worried about her deposit fund, so she would have done any kind of a deal. And then JP Morgan Chase, who really had a real appetite to get Washington Mutual because it would instantly turn it into one of the biggest banks in the world with its extensive branch network. So the next slide we have is a little bit more about the facts I was telling you about. This is a data put together by an outside independent agency, Inside Mortgage Finance, and it shows the mortgage origination of the top 6 banks. The thick blue line in the middle is Washington Mutual, and you can see starting in 2003, Washington Mutual, Countrywide, and Wells Fargo were the top 3 mortgage originators. But Kerry didn't worry about being the biggest. He wanted to be the best. And he saw a crisis coming in 2003 because of the explosive value of homes, the housing bubble, and also the explosion of Wall Street securitizations. And so what he did is he just downsized the whole mortgage function. He cut mortgage originations in half in 2003. And between 2003 and you'll see in 2007, reduced loans by 74%, laid off 15,000 mortgage workers. So this was not expanding mortgage lending. This is dramatically decreasing it. The next slide also shows from risk reports that Washington Mutual did not decrease lending standards. They continued to increase lending standards every year. This is a chart showing increased FICO scores from 2004 to 2008. Washington Mutual improved all of its loan standards, including requiring additional loan to value standards. The next slide. This is data from an outside independent source, the First American Loan Performance TS Securities. And what this chart shows loan delinquencies in the industry and also Washington Mutual from September 2006 to September 2007, which is when the crisis started getting bad. The red bars indicate the industry loan delinquencies. And by September of 2007, they have risen over 3%, which is very high in mortgage lending. The blue bars is Washington Mutual. Their loan delinquencies just went a little bit above 1%, showing that Washington Mutual's loan performance is much better than the industry. Next slide is Washington Mutual is accused of not having enough capital and liquidity. However, this slide shows that Washington Mutual had the highest capital ratios of all the 6 largest banks in the country. There's 2 sets of capital ratios. The first set on the left, the blue bar, is Washington Mutual. All the other banks in order are Chase, Citigroup, US Bank, Bank of America, and Wells Fargo. You can see in the Tier 1 capital, Washington Mutual had nearly 10% Tier 1 capital, the highest of all the banks. The second set of the graph, again, the long blue bar is Washington Mutual, and Washington Mutual again had more, this is risk-adjusted capital, and had nearly 14% of the capital ratio in risk-adjusted. There's also been some misinformation about the Washington Mutual's daily deposit balances. Washington, right after on the left, right after IndyMac was seized, Washington Mutual, like a lot of banks, lost deposits. They lost about 6%, but quickly recovered, as you see in the line. And by August of that year, within about a month or so, they were back up to 140 billion in deposits, the daily deposit balance. After the Lehman bankruptcy, there was also a drop, but Washington Mutual, as you can see on the chart, quickly stabilized. Even though they lost about 9% after Lehman failed, they quickly recovered and were stabilized when the bank was seized. In summary, Washington Mutual thought that they had done everything they could to get through the crisis. They had the highest capital ratios. They had $50 billion extra in liquidity. They had their FICO scores and LTVs were better than the industry. Their loan losses were better than the industry. And they dramatically dropped lending. So Washington Mutual should not have been seized. In fact, by 2010, Hank Paulson, in his book On the Brink, admitted that he really regretted that Washington Mutual should not have been seized, that it was a systemically important institution and there was no reason to seize it. That also, later on in 2013, the former FDIC chair, William Isaac, did an independent study of Washington Mutual, and so did Michael Mancusi, who was the former deputy controller of the OCC. They also said Washington Mutual should not be seized. A long-time 2-rated bank who had high levels of capital and liquidity should not have been seized.
Well, thanks, Linda. Okay, let's move on to the third section here before we get to our questions. First, what's happening today? Look at as I was critical of the Fed in the leading into the recession. They did not provide enough liquidity. They finally saw the errors of their way and then injected the system with massive liquidity starting in 2008, 9, 10, and so forth. The problem, and that was the right medicine for the time to get us out of the problems that were going on. But they didn't stop there. They got hooked on their medicines, and we kind of became addicted to the idea of very low interest rates, lots of money all over the place, and the Fed itself buying lots of assets. And when they buy assets, that forces investors into riskier assets like stocks and real estate, housing, and so forth. And what they did is they continued with those loose money policies now for well over a decade. And what happened is everybody responded rationally. Investors responded by bidding up the prices of everything. So stocks have all gone up, housing's gone up, collectibles, newer speculative assets are coming into the equation now. You're all reading about cryptocurrencies and SPACs and NTFs and exotic ETFs that with new things or new kinds of exposures that we have never seen before. And many of these are highly leveraged and often are done by shadow banking companies that are not regulated. The other thing that happens when you have super low interest rates is people are not stupid. They go out and borrow a whole bunch, led by the U.S. federal government, and corporations, and individuals. All took on a lot of these debt, and so we call these both asset and debt bubbles that simply get created when too much money are chasing a limited number of assets. And whenever we see that happen with lots of assets and more speculation coming into the system, we have to be raising the flag about, is there some kind of a bubble that could break someday that could be real troublesome to us? And let me look at just a couple of things behind this. As I mentioned, whenever the Fed keeps interest rates below the rate of inflation, these kinds of bubbles tend to get created. In the last several years, you can see the red line, which is inflation, has been well above the federal funds rate of where the Fed has set rates. And more recently, the rate of inflation is picking up and growing again, and the Fed funds rate is still close to zero. So that difference is getting even wider. I mentioned the last time they did this was in the early 2000s. That led us up to the housing bubble. So let's look at what's happened to some of these assets, and we call it the bubble of everything. I know we all feel good when this happens, and if it never corrects or never falls back to earth, great. But unless there's some change in the laws of physics, I'm not sure that we can grow at above average or astronomical levels without having some kind of a correction at some point. So clearly the stock market is well above what we estimate a trend line or intrinsic value. One of the reflections of that is called the Buffett Ratio, because Warren Buffett for decades said this was the best measure of value. Look how it kind of stayed on that trend line. And then the dot-com bubble, we all know it was kind of frothy, right? And so look at how overvalued it got. And sure enough, it fell down and then came back. And then the financial crisis hit, it got way undervalued and then came back. But look where it is today. It's kind of an all-time record in relation to the GDP. Again, big red warning flag. What about housing? Housing was in a bubble, as I said, in 2006. That's why we took all of our corrective actions at Washington Mutual. That's why we tried to get ready for it. And I thought housing was about 20% overvalued. You can see how it came back down, but the reason it went down even further were because of the inept policies that the Fed and others did at the end of not enough liquidity early enough. And that's why it went down so low. But look where it is today, well above the peaks in before the last housing bubble on a national basis. And in certain markets, certainly Seattle, Bellevue, as an example, have grown much faster than that off the bottom. So certainly in a period where prices are rising much faster than the rate of inflation. You might ask about how that shows up in commercial real estate. Again, similar, commercial real estate was starting to get above valuation, or what we thought was a trend line. Coronavirus, COVID-19 did have an impact on bringing those valuations down, in part because of the changes in lodging and restaurants and use and need for office space. How about art, collectibles? Art art has outperformed common stocks. You'll notice that the Wilshire 500 index over that long period, it's done very, very well. But art has even outperformed that by quite a margin. Now, one of the challenges is that, yes, we've created an awful lot of wealth and the like, but let's talk about the proportionality of that wealth around the country, Linda.
Yeah, what's happened is that household net worth is getting concentrated in fewer and fewer households. So what you can see is in the kind of the middle of the chart here is about 2010, and that's when the economy started growing a bit. But you'll see that the bottom 90% have not participated as much as the top 10% in the gains that have happened in the asset categories in the last few years. In fact, the bottom 50% of households in this country hold only 1.9% of the net worth, and there doesn't look like they're participating a whole lot with all this growth. So the other index that we like to look in for equality is the Gini index, which is the net income inequality. You'll notice this goes from 1920 all the way to 2020, and you'll notice on the left that the prior peak was the peak of the inequality in this family inequality in this country. The peak was right before the 1929 stock market crash, which showed high inequality in the country. That is, you'll see on the right, it's almost there now. So we're getting close to the peak in inequality that we had before the 1929 crash, which means there's just less and less of a middle class.
Yep. And and switching, you mentioned about these bubbles, not only the assets, but people are just out borrowing up a storm, led by our federal government. $1 trillion a year budget deficits prior to the COVID, now guaranteed to be $2 to $3 trillion a year for the foreseeable future, and may get even bigger depending on some of the packages being considered. So we now have $28 trillion of debt, the highest level of debt in relation to the GDP since World War II. But in World War II, the war was going to be over and it came down quickly. Now, our government expenditures are so high and so permanent, the Congressional Budget Office expects this to keep growing even further. And corporations have done the same thing. They've gone out and borrowed in record levels, now the largest percent of GDP in the history of our country. So one perspective, I like to have people be centered. And again, it's kind of like, we don't know when things are going to correct or how much, but what I try to do is saying, if you think 2% inflation is a good long-term number, where should interest rates be? And in that case, the Fed funds rate should be about 2%, but it's at zero or close to it. So way under, that's called negative interest rates. The 10-year treasury should be about 3%, and it's only about 1.6 today. Mortgage interest rates on a 30-year fixed rate mortgage are about roughly 3% today. And a more normalized relation to inflation is like 5%. And the same with corporate bonds. So the question I put out there for y'all is that over time, if we get back to a more normal situation, what will happen to some of those asset prices if interest rates do return to those historic norms? And in the case of residential real estate, if interest rates were at 5%, the affordability of houses drops dramatically to make those higher mortgage payments, and that would tend to put a downward pressure on some of the prices. So I think just as we look at the risks that we have today, I mean, we have very simple policy recommendations. First, we think the Fed should, instead of waiting until it's too long, and still waiting until we have too much inflation, too many asset bubbles, start increasing interest rates gradually now and start reducing your asset purchases. And second, get the federal government to rein in its unwieldy spending and get that budget deficit down to less than $1 trillion a year. I also make a note that state and local governments have $4 trillion of unfunded pension liabilities that they better address before that gets too late. And we certainly encourage the regulators to stay on top of these very fast growing shadow banks and the riskier assets that are being produced there. And finally, that the political finance reform should be considered in our country. So in summary, again, for us, there are risks, they're growing, they're real. Everybody is closing their eyes to it, in our opinion, right now. We want the dialogue going on out there so that maybe we can deflate these bubbles before it gets too late and we have a repeat of the 2008 financial crisis. So I know we've kind of run on. I think with that, we'd be happy to stop this portion of the program and take whatever questions you might have.
We are running a little bit late here, so I'll take one question here that was out, and then if you wouldn't mind, or if you can, stay just a minute or two after, and there may be more questions.
Okay.
Several times in your presentation, you talked about shadow banks, and the question here was, could you be more specific about what and who a shadow bank is? Maybe even provide names that people might recognize.
In the 2008 crisis, the shadow banks that were building up were banks like Ameriquest, New Century, First Franklin, probably banks that you never heard of, that produced 85% of all the subprime loans, that performed like 2 or 3 times worse than the regulated banks. That was the last crisis. Right now, we have got a huge shadow banking system with names like because most of the mortgage loans right now are done by shadow unregulated banks, like on the online banks.
Yeah, I think when the shadow bank is somebody who is not regulated by a federal banking regulator and is involved with financial services. So the biggest ones would be like hedge funds, asset managers, large outfits like a BlackRock. I mean, I'm not trying to pick on them, but it would be examples of that. Shadow banking assets now, last I saw, were about twice the size of regulated banks and are growing at about twice the rate. And that's where all these new hot products are being developed. I'm not worried about regulated banks in the next crisis. They look well capitalized, well positioned. I'm really worried about how are things going to go if some of these leveraged ETFs blow up, or SPACs, or cryptocurrencies, and they're all getting interrelated out there, folks, and nobody knows exactly how leveraged they are and what will happen when something happens there.
Great, thank you. And again, if you are able, hang around for a couple minutes after we close the meetings. I know there are a few more questions.
Oh,
Okay,
great.
So I want to thank you again for very informative presentation today. It was interesting to hear your perspective and the historical overlay on that. I wanted to let you know that in honor of your presentation today, we're making a donation in your name to Harvest Against Hunger, which provides 1,500 pounds of fresh produce to local food banks. So thanks again for coming.
Oh,
Thank you very much.
thank you very much.
You bet.
Appreciate it.
Next week's program is Bill Tobin, who will talk about shelter box relation. He's the shelter box relation manager for Rotary, and he'll provide an update on the shelter box program. Thanks to Jeffrey and for helping out with our meeting production today, and for Steve McConnell, who constructs for the meeting facility that we meet in. And we thank you all for joining us today. This meeting is now adjourned.